Most investors own too many funds, pay too many fees, and still underperform the market, and the fix is simpler than you'd think. Welcome to the Lazy Portfolio Strategy, a 3 ETF portfolio built for long-term investors who want diversification without the complexity. The concept behind this diversified ETF portfolio is straightforward. Instead of picking individual stocks or juggling dozens of overlapping funds, you hold just 3 low-cost index ETFs that cover the entire investable world. The first ETF covers the total market ETF, covering the US stock market, giving you exposure to thousands of American companies across every sector and size. The second ETF covers international stocks, developed and emerging markets outside the US, so your portfolio isn't dependent on any single economy. The third ETF holds bonds, acting as a stabilizer that reduces volatility when equity markets pull back. Together, these 3 holdings deliver genuine diversification with minimal overlap and rock-bottom costs. As Warren Buffett has said, the goal of the non-professional should not be to pick winners, but should rather be to own a cross-section of businesses that in aggregate are bound to do well. That's exactly what this index fund portfolio for beginners delivers. Now, how do you split the allocation? A common starting point is 60% US stocks, 30% international stocks, and 10% bonds. But your exact split should reflect your age, risk tolerance, and time horizon. Younger investors with decades ahead often hold fewer bonds, while those closer to retirement typically shift toward more stability. The key principle here is set and forget investing. You contribute regularly, rebalance once or twice a year, and let compound interest do the heavy lifting over time. Historically, total market index funds have outperformed the majority of actively managed funds over long rolling periods, a fact consistently documented by independent research from firms like S&P Dow Jones indices. Peter Lynch once noted that the real key to making money in stocks is not to get scared out of them, and a simple, passive strategy using long-term investing ETFs makes it far easier to stay the course during downturns. This approach also eliminates the temptation to time the market, which research shows destroys returns for most retail investors. Passive investing today isn't about being lazy, it's about being disciplined, evidence-based, and efficient with your capital. You don't need 40 funds, a financial TV subscription, or a hot stock tip to build real long-term wealth. You need 3 ETFs, a consistent contribution habit, and the patience to let the market work for you. Remember, past performance doesn't guarantee future results, and your allocation should always match your personal financial goals. If this breakdown on ETF investing basics was useful, hit subscribe. We cover long-term investing strategies like this every week.